Hello, everyone, and welcome to Your Finance TV to kick off your work week. And wow, this one could be a doozy. We welcome back Brendan McCarty from Column E. How are you, Brendan?
Great. How you doing this morning?
Not too bad. Still a little bit out of whack with daylight savings kicking off, but all good. Before we kick off the show, don't forget to click on that subscribe button and like buttons just below. Once again, we have plenty of great content coming out. Just don't even forget, like as an example, we had SJIM, the short Gym ETF founder, Matt Tuttle on just the other week. So make sure you sign up. Unless you've been on a deserted island and just getting back into civilization for the last 4 days, Silicon Valley Bank, which was the 16th largest bank in the US, is in the hands of US banking regulators. Late yesterday afternoon, the same fate happened to Signature Bank as well. This will all be broken down over the coming weeks and months as to what went wrong. Was it management's fault? Why wasn't this picked up in stress tests? Was it the fallout from this that we haven't thought out? Is there going to be fallout from what we haven't thought of yet? Brendan and I are going to try and break all that down this morning before we jump into Brendan's Love It, Like It, Leave It picks. You ready, Brendan?
Let's roll.
Some of our viewers know of 2008 but didn't live it. But from books, we didn't, and they've only learnt from books. But Brendan was working at Bear Stearns then, and I was working at Merrill Lynch, but didn't know one another. I can tell you from my side, it was one of the most surreal and nerve-wracking experiences in my working career. But I was lucky enough to have Greg Fleming put together a deal that saw Bank of America and Merrill Lynch come together. Still remember getting calls from hedge fund friends on a Sunday night to turn on CNBC because we were a little bit blindsided at Merrill Lynch back then. Brendan, you were at Bear Stearns. What was your experience like in 2008?
So mine was 6 months before yours, in March of that year. But really all started for us 6 months before that when we had two hedge funds explode, literally go to zero overnight. There was a subprime lender in there that went to zero in the hedge fund, and it just made the whole hedge fund zero. It was the most amazing thing I've ever seen. Um, but that was the first stress that they put on Bear. And on the desk, so desks today were not the same as desks back then. Desks today are offices, and people don't talk to each other in the financial advisory world. The trading desks have sort of shrunk or disappeared. They're much smaller than they used to be. Back then, you had equity traders, option traders, preferred traders, muni traders. Everybody was on the same floor at Bear. So we all shared stories together, how things were in the markets, how things were here, how were there. And leading up to this, it was like when the funds went down, we sort of like, yeah, that makes sense. Like we weren't sort of like it was amazing to see it go to zero, but we weren't surprised, strangely enough, because we saw a lot of subprime was a virus in the system that was getting worse and worse by the time it started in late 06, 5, 6 when the housing markets toppled or topped, and then it just got worse and worse. So when Bear started to fall, we were like, "Oh, Bear won't fall because Jimmy won't let us fall." And then Jimmy was gone, and they put the parking cone, Alan Schwartz, in there. I shouldn't be mean, but Alan was over his head. It wasn't like it wasn't supposed to be. This wasn't his thing. He wasn't supposed to be. I think he was head of marketing or head of something else at the time. And it's like the whole ship deserted and left him. So it was his turn to try to make the company survive. And that week where we went down was the most incredible time. Like I remember talking to a buddy of mine. He says this every time because he said, "I couldn't believe when you told me on Thursday night that Bear wouldn't exist on Friday." And I'm like nobody believed it. And I'm like, "Yeah, we're about to be seized by the Fed," because we had all heard it. And Alan Schwartz on the wire saying, "We have plenty of capital." Does that sound familiar? We heard that from SIVB earlier this week. That's what gave me like, wow, isn't this amazing how we repeat in time? But if you think about it, how many people today in the markets today really took part in '08 so closely, like you and I? Like we were right on desks, like we were right in the middle of it. And there's people like corporate treasurers, that guy from SIVB, I can't, or gal, I don't know who the treasurer was, but who knows what they were thinking? Like they were just trying to match liabilities and whatnot. But I mean, I think we'll talk about like a 1.5% mortgage for 10 years. I mean, like that's just insane. But that's just the way. Like people didn't feel what '08 was all about. When it was all said and done, I remember Friday morning the Fed closes us down or stopped our trading on our stock at $30. Woke up on Sunday. I didn't wake up, but all weekend we sat there texting So we were on Blackberries at the time. So we're all Blackberrying each other because the iPhone didn't exist. That did exist, but it wasn't that big a deal. But we're all messaging each other, trying to figure out what's next, what's next, what's next. And all of a sudden, we're like $20 per share. Well, that's not terribly bad. You know, JP is going to buy us up. And then all of a sudden, no, everybody's like, no, it's only two. So Monday came around. We spent the next month fighting with Jamie Dimon and Bear. Like we just said, we're like, you're taking the best parts of Bear and you're giving us $2 for it. Because JP Morgan gave the rest off to the Fed. And it was just one of those, it led to the problems that summer with Lehman. It led to the forced merger with Merrill and Bank of America, which none of us saw coming. We knew Merrill was in trouble from, like, we were hearing issues with Merrill I don't know what you can probably elaborate, but we heard issues with the loans, the loans against portfolios, which Morgan Stanley, by the way, does that today, that were souring and that was causing portfolio problems. And then that was leading into a portfolio issue and yada, yada, yada. And then you hear later that year, Merrill had like 50 billion in sour assets that Bank of America had to absorb, and they didn't want that. So the Fed had to step in and do something about that. It was just a surreal time. But like SIVB going down, this is the tip of the iceberg. If this is what the tip of this is Bear Stearns today, I don't know what's going to happen in the fall. I hope it doesn't happen again because it was a pretty surreal time.
It was crazy. I listen, lived it, didn't enjoy it. But I remember coming back on the Monday morning and thinking, what's even going to be happening here today? And it was like business as usual. We're getting orders, we're executing business, trading. I was running the emerging European desk at that stage. And I just like, no one had ever been through that before. And I was shocked. That was just, we're ticking along. Like, we even got bonuses at the end of the year. It was crazy.
Yeah,
I really didn't
that wasn't such a popular subject.
Well, yeah, it's like, I'm sure that this is all going to come up in this, and there's going to be very angry people. And like, we'll get into that a little bit further down the road here, but especially when we talk about Fed rates and so forth. But it was just an incredible time. And so Greg Fleming did an amazing job of putting that package all together with Bank of America. And I still like want to shake his hand. I haven't seen him since those days, but it was now for people going through this, it's just I really don't feel like the public's really felt it yet, and we'll get into side effects. But let's jump into where this all did go wrong. Silicon Valley Bank had been a huge success. In the space of 3 years, SVB had gone from $55 billion in custom deposits in January 2020 to $186 billion by December 2022. But what to do with this new extra cash was the big problem for them. Well, SVB put some of that new capital into high-yielding, long-term government bonds. And what seems crazy now, $80 billion into 10-year mortgage-backed securities paying 1.5%. Ironically, a similar mistake that Bear and Lehman made back in the 2000s. Brendan, did you hear any of that speculation that rates might be going higher at some stage last year?
So I looked it back when the Fed started hiking in when they started May. The forward curve was 2.5%, maybe 3. We were saying if you go over 2.5, you're gonna start causing stress in the system. We were comparing it to the CRB, and anything over 2.5 is going to cause a problem. And so, if you're
I was sort of looking for a yes or no.
Yeah, I will just say that market didn't see 5%.
Okay, so put this together: high rates, less IPOs, misreading clients' needs, and more that SVB risk management didn't really seem to do anything about. They had to sell $21 billion in longer-term assets at a $1.8 billion loss, and also try to raise an additional $2 billion in the market. And from what I'm hearing from different funds and so forth, that deal was not handled well at all, which we can obviously see. It sounded and smelt like a fire sale, and now we're here. Now, the question here, Brendan, you can combine all of it together, why wasn't this caught before it was too late?
So what was interesting about I saw something on Twitter. I can't believe I'm remarking so much about Twitter today, but I'll say this: part of this was mismanagement of the story. So if they had just raised $2 billion and not said a word about it, they're going to use it for capital purposes or whatever it might be. I know it's hard to sell a stock in the hole when the stock is falling like this, but the idea was if they take in 2 billion, then they can take that $1.8 billion loss, and all right, so two, and you cover the loss and some, right? Then you got 21 billion of new money to reinvest in the markets higher. It's actually not such a bad idea if you're trying to reposition the portfolio. Banks sell assets all the time. They don't sell them in the hole like this because typically speaking, the rate markets are higher and they're selling 5% coupons or 4% coupons. But it goes back to the fact that over the last 15 years, where's the average funds rate been? 1.5%, or maybe even 2, right? Like the Fed got to 2.5 and had to go down to 0 at pandemic. It's gotten up to 5 this time, and chances are it's going to have to go lower to fix things. SVB, I think, is a product of its environment, but it's also a product of the free money that the Fed and the government all gave out right after the pandemic started. If you like, I had a pleasure speaking to the Market Technicians Association last week, and we talked about money. That was my whole thing. Money goes up in the system, assets rise. Money goes down in the system, assets fall. Money fell throughout last year, and part of that was, less money to invest in other assets. So the SVBs of the world were probably feeling the stress mid-year last year. Like we have a little chart for banks versus money, and you could see the stress was forming. Yet the Fed continued to plow on. So I would chalk up SVB. I'm sure there's probably something there sinister somewhere, but I bet you if they had just done the $2 billion offering, then just sold the $21 billion in securities, taken the $1.5 billion loss, there may have never been a bank run. They probably, like what happened was these guys get on Twitter and say, take your money out and run. I mean, it's like, I don't want to say it's irresponsible, but I also want to sound, when we were so you and I are in the brokerage world back then, you heard this stuff. Get your money out of Merrill. Get your money out of Bear. If you had taken your money out of Bear Stearns or left it in there, nothing would have happened. You would have, SIPC protected it all. So people throw these nonsensical, like I feel for the people that have money in accounts with SVB, but corporate America needs to wake up and realize that your FDIC insurance is $250 account. In a worst case scenario, you're going to lose money. That's just the way it is. And like at Column E, we never carry more than $250,000 account. We stick it in a money fund that's outside the bank. So if I grant that money funds weren't without problems in 2008 either, but it's just risk management on the corporate side. And SVB's corporate side like fell asleep, but all their clients did too. Like all their clients should have been like, why is Roku holding $520 million in cash? That was on the wires Friday night. Why in God's name were they in cash? Why weren't they in T-bills? For God's sakes, 5% T-bills on $520 million? I mean, that's free money. I mean, that's just stupid. And I think corporate America fell asleep too. I'm not saying that all these corporate America companies are to blame, but everybody fell asleep. It's literally, this is the ultimate wake-up call for corporate America. It's a wake-up call for the regulatory authorities. It's a wake-up call for anybody who had money there, who's thankfully getting some of it back today. This is what if SVB had just followed a simple $2 billion offering, sell the securities, and moved on, we may have never heard of any of this. It may have happened down the road, and it was great. There was a great story on Bloomberg this morning. The UK pension system was the first warning across the bow in this. When rates went up too fast in the pensions over there, because they were asleep at the wheel, they had problems, massive problems. It forced the Bank of England to inject billions. I don't know how big their system is. Half of something. Lots of money into the banking system over there just to keep it stable. Well, this is going to continue to happen. The more the Fed pushes, the more these things are going to happen. And they have to take their foot off the pedal so more SVBs don't form. It's just the way it is.
Well, you also saw the panic run through regional bank names like First Republic, PacWest, Signature Bank, which obviously we talked about before, which has now been in the hands of the government, and Western Alliance Bancorp. After Yellen said that Treasury were also monitoring a few regional banks after the Silicon Valley Bank announcement, but she was also right about Signature Bank. You can argue First Republic as well. Like even this morning, like we're recording this pre-market, but First Republic down another 65% this morning, and
Is it
Western
really?
Alliance down another 60 odd percent. Pac West down another 40%. Even some of the other smaller ones, which we didn't really touch on, but Finwise Bancorp and Bank United, like all down like big percentages. First Republic was one stage was down more than 50% on Friday. So it's been a big drop over 2 days. With volatility like this, I usually stay clear though, Brendan, and wait for it to settle down. But they can create some opportunities. So let's look at the ETFs. XLF, which is the financial sector ETF, and KRE, which is the Spider Regional Banking ETF. If you're a believer of oversold RSI levels, maybe you should be looking at these and waiting for that turnaround. Brendan, what do you think about these two ETFs?
I would stay away from both of them for the time being. And it's more the charts themselves. Yes, they're oversold, no doubt about it. I could, from a price perspective alone, you could. There's a trade there probably. I think like guys in the know on Friday were buying into the bigger names, the bigger players. Regionals are gonna feel the stress of this because the regionals have the younger employees, if you will. So there's got to be more SVBs out there. It can't be in isolation. So guys who mismanage their portfolios, whereas the bigger banks are scrutinized by the Fed, and they have their portfolio scrutinized not only by their own treasurer but by their CEOs like Jamie Dimon, and the authorities. So while I see them both oversold, and I could say a case for a trade, you're dealing with a lot of news risk right now. Like First Republic, that is a roller coaster. Honest to God, like we have our money in First Republic. I'm not concerned about it. I mean, but we're under the insurance minimum, so it's like I'm not worried about it. I did what I had to do as a corporate money manager. I did what I was supposed to do. If FDIC goes away tomorrow, well, then we're up the creek. But that's a different story. I would just say with the XLF and the KRE, if I was a lean one way or the other, I would look at the XLF, but because the XLF has actually been beaten up more than the KRE, relatively speaking, in a model that we use. XLF's been feeling the pain a lot longer than the KRE has, which is probably why the KRE, you're seeing these massive moves in the regionals, because people are probably buying the more risky KRE and selling the XLF. I think that's why you're seeing the moves a little bit more dramatic. I would basically stay away from both, though. I'm not a big fan of trading the news. It's hard to trade. Like we had in our love it, like it, leave it. We trade the news all the time, right? But the news late last week was insane. Like people were missing earnings by a little, and the stock was down like 20%. Like it was just it's a product of the news, and banking news is different. Banking news is fearful. Like if it's one thing for I don't know what we talked about last week, but let's just say Baidu. We talked about them before. Baidu reports a drop in retail earnings. Well, you know what? So be it. They're going to go down. Fine. If you're a regional bank that you have all your money with reports a sizable loss, there's an emotional tag to that, which means the news is more emotional. So trading these things is harder when it's an emotional environment. You got to buy the very extremes on these things if you're going to do it, and take profits on little whims. I don't know if maybe this is me being too risk averse, but I don't think I'd touch either one of them right now, long or short. That's just not. It's just emotional news is extremely hard to read, and based on the way the futures trade overnight, it's that you're seeing it.
Okay, I want to get into an important part of this because who did know about this beforehand? Monday and Tuesday saw huge MOC volumes, heavily weighted to the sell side. Considering was happening last week with Powell speaking, Jolt and jobs numbers, and Biden giving his budget speech, I found it very unusual that was happening beforehand. Did people know? CEO Greg Becker sold $3.6 million of stock roughly 2 weeks before its closure. And if anyone had an inkling, it would have been him. But in his defense, you usually have to file well beforehand that you're going to sell stock. Is that a defense? I don't know. And shouldn't stress tests have shown some sort of risks here? What I'm trying to get to here, Brennan, is who's to blame? As I feel we should not be in this position in this day and age.
So I'm going to go back to the Fed. plugging too much money in the system and jacking rates up too quickly. But there's more to go around. Again, it goes back to the inexperience on the banking side. We've been in such an environment since '08 that complacency reigns supreme. Like pandemic, everybody got free money. During remember 18 and 19? Remember crypto went straight up and then it collapsed into 19? Well, the Fed was dealt with a problem then, and they had to drop rates. So they probably, if they had just responded to the markets initially, they wouldn't have had to been so aggressive in the fall, which led to a bubble-ish condition into the beginning of 20, which then led to a crash, then led to all this more money coming in. They plug everything with money over and over and over again. And this time around, they decided, all right, we're going to ignore all the money and we're just going to raise rates to the moon. Well, you know what? You're destroying your own banking system by doing that. I remember talking to a client years ago about Iceland. Iceland's short rates were like 13%, if I'm not mistaken, and their long rates were 5%. They were devastating their banking system in the name of, it was some stupid number like that. I don't know if it was 13 versus 5, but it was some silly number where the short rates were sizably above the long rates. So the central bank was basically saying to the market, you don't know what you're talking about. We know what we're talking about, and this is what we're doing. And this is the Fed saying to the market, you don't know what you're talking about with long rates at 4.5%, and we're just going to continue to raise rates. Well, you know what? That doesn't work. You need to listen to the markets. The markets are telling you there's stress out there. Now, with the selling this week in Becker, I doubt Becker knows a thing about his portfolio. I bet he's a manager. Is a banker. I'm sure he knows basic portfolio management, but he probably doesn't get into the weeds of it because he pays somebody else to do that. And his team is roughly to blame the way they handled the setup for it. If they had just followed a very simple procedure, sell $2 billion of stock, sell the portfolio, take the loss. Simple, done. We wouldn't have a bank run, but they screwed up. And that's on their team. That whole team should be blamed for that. The stock sale, again, those are long in advance. This is tax time. I bet you that was a tax sell of some sort because he owes payments in a couple weeks, right? He's probably later, but you got my point. It's tax time. So I guess the blame and the one more thing, the selling to be in the week, the hedge funds are heavily short the banks coming into the last week. This was an old-fashioned bear raid. I bet you somebody got wind of this $2 billion sale and then put the things together because guys on desks can see this stuff. Gals, they can see the stuff on desks, and it wouldn't surprise me at all if they just put the pieces together. Some computer did, and then all of a sudden you had an old-fashioned bear raid come right after the bank. We have so much data out there these days, it's hard to sneak things through. And SVB managed it so poorly in terms of how they were doing it. And you know what? It makes sense to doing what they're doing. Take money from the equity side, take the loss, reposition the portfolio so you can buy higher yielding bonds. It's a good play. It's a really good play. But they screwed up, and they screwed up the whole play of it. And then, all right, some opportunistic hedge funds who were short, get your money out, gotta run. That's a bear raid. It's old fashioned. You don't see them as much as you used to anymore because the SEC tries to crunch down on them, but they can't prove it out this time. So I would just say this was many people at fault for many different reasons. And as much as I would like to say SVB is to blame or the Fed is to blame, everybody has their finger in the water here. They're all in the hand in the cookie jar. And the data ultimately proved it out. It led to an opportunity to blast the markets and they took the banks down because they're all heavily short, and when they're all heavily short like this, they don't usually make money. So they were fortunate to do that this time around.
When you're referring to the whole the bear raid side of it, I always think of that scene from The Simpsons where Bart Simpson's in the bank going, "We're running out of money, you can't get your money out," and so forth. I think I actually have seen something on Twitter about that this weekend. I still think the stress tests have got a really big thing to answer here, which is obviously comes back on the Fed and regulatory authorities. I had to look up on my phone, 93% of the bank's $161 billion in deposits were uninsured per a recent regulatory filing. That's a huge number.
Yeah, but look at minimums. Like maybe the FDIC minimum is too low. I mean, the Fed, if you look at the level of money today versus the last time they updated it, we're looking at 10 times the amount of money in the system today than it was then.
So, okay. So the Fed's been sleeping at the wheel as well now, or the regulatory authorities have been sleeping at the
Yeah.
wheel as well then. You've got
Yeah.
to move
Everybody,
with the
I
times. You
mean,
can't
everybody's
sit there.
playing. It's
It's like it gets like you saw me get angry about crypto. I'm frustrated at this as well.
the good thing is if this is the wake up call for everybody, and I hope it is. Like I only know the 250K minimum because I sat through the last time we argued over 250K minimums. It was 2009-10. All they did was they wanted it higher. They wanted it higher. They wanted it higher. And then it became what was it? Investor risk. They said, well, if we go higher, people will get complacent. So I mean, I don't know. What do you want? Like, you either take the two. Maybe the 250 does need to go higher. People's portfolios are a lot higher than they used to be. And
But why does it matter? They're bailing the whole thing out anyway.
yeah, I know that's the problem. So maybe this is the Feds acknowledging that. I don't know. I don't understand why they didn't go the discount window to start with to fund this. I'm kind of confused on that one. I don't really know banking mechanics that well, but I will say they opened the discount window last night to everybody. It's always open. They just didn't want to borrow it. What are we at? What are we at? 4% discount right now. They could still literally borrow it. So when the Fed opened the window last night to this new package that insures you against losses, sounds like Bear Stearns from '08, doesn't it?
Mm-hmm.
Uh, Basically, you can go buy a 5% T-bill and borrow it at 4%. So you lock in 1%. They gave the banks 1% overnight if anybody's willing to take it. Now, JP Morgan, I don't think is going to go to the discount window and borrow $500 billion to go lend it at 1%. But they could if they really wanted to.
But they did back then as well.
They
The
did.
banks
Yeah,
loved it. And they're going to do it again.
free
You put
money.
an opportunity in front of someone like that, you're going to grab it.
It's a smart move. It's corporate management. You're like, oh, I can earn 1% for doing nothing. That's what the Fed just did last night. It's just like I hate to keep blaming government authorities here, but I have been on this. We have been talking about this for 2 years. There's too much money in the system, and if you put too much money in the system, too much risks are going to form, and this is what's happening. And this is the tip of the iceberg. There's going to be other sectors that run into problems. Banking is taking the stress of it because all these small businesses are having trouble. They can't. It's just like getting money from a bank right now is hard. It is really hard. They have all tightened up lending standards big time, and this started, I don't know, 3 months ago. Like at the turn of the year, borrowing from a bank was hard, or the terms were insane. So then that forces you into the third market, and then the third market is an SIVB, right? They're the ones who lend you money at a higher rate. Well, now you're in the third market, which all blew up in '08. SIVB is the third market. I know it's a bank. I know it's FDIC, but they're a third market because they have 93% of their deposits not insured. And it's just, it's a sign of the times. And it's the Fed's going to plug it with money like they always do. And then we're going to the water's going to go somewhere else and find another crack.
Now, listen, we can break this down for a long time, Brendan, but the last bit I want to cover on this for today is who else is going to be impacted here. And are we at this? Are we at the Bear Stearns level? Like, and then 6 months down the road, something else is coming. Obviously, there could be some big impacts we see over the coming months for tech companies and healthcare companies, for that matter. I saw an article that 2% of Silicon Valley Bank's clients were winery-related businesses, and this could have a huge impact on that industry as well. It might be too early to tell, but who do you think are the industries or companies that will be impacted the most from this?
So this is a really tough one. My first thought was other regionals are going to suffer capital flight. So they're going to lose assets to the bigger players like a JP Morgan. I think the joke over the weekend was JP Morgan had to bring in a whole bunch of new customer service reps just to field all the phone calls they were going to get. Not a joke. It's kind of sad, really. JPM is a great franchise and also probably the most systematic entity that if it ever failed, we'd all be dead. But aside from that, I would just say that if you're a business that's borderline having trouble borrowing, and then all of a sudden loses access to his cash, that's majorly debilitating. I don't know. I mean, a lot of tech is having trouble right now because the VC pipelines have dried up a little bit. People aren't sure where to put their money. Real estate's having problems, so those people, that's passive money, so passive money's having a problem. I would just say any borderline small business is going to suffer. A winery is very seasonal, right? So they probably have cash flow issues from time to time. They're going to feel it. But I think the biggest thing will be, the pain will be in the regional banks, only in that money's going to flow from one to another, or just leave them entirely. And you're going to have capital flight from what is the growth business of this banking system is the regional banks. That's what grows there. You need regional banks. You don't need multinationals all over your system. And everybody will acknowledge that. So I think it's tough to say who will suffer. I'll just say it's probably borderline people. Like I've seen restaurants go down over the last 6 months that they can't meet their costs, right? So they use cash to fill in the gaps. Well, if they lose there was one in town here, pizza place. The bank refused to lend them any more money, and he just shut the doors. He was like, "The hell with this! If I can't borrow, well, how many companies now can't borrow and don't have access to their cash, or can't borrow, period? And now this impacts everything. So the banks are going to have to recognize, be more custom. There's a lot of things that go. It's kind of too early to see what's going to follow. Tech obviously has felt the pain. We've seen that for a year. But I think smaller business is going to feel the pain too, because they've already lost access to lending. And if this money starts flowing from place to place, and that's another corporate decision you have to make instead of, go marketing your business, that's going to slow down sales too.
Yeah, it's probably those small cap companies, smaller private companies, the tech companies that aren't making a profit yet. And listen, we've been through it ourselves, like going to get those loans and so forth. Now it's going to be much different terms, much harder. So
yeah,
what's that? Sorry?
They're going to have to make money on the loans. Like the terms that they were offering before, like let's just say 6%. Maybe that's a 10% yield now because they actually have to make money on that bond. Like they're lending out, they can't go into the market easily to they give the cash out. They can't really easily hedge it. So instead they just charge 8%, 9%, 10%. And what small business can absorb that?
They can't, especially if you're a startup and
right.
It's slow out the gates. It just doesn't work. So lots of questions. And as I talked about in the show on Friday, like there's doubt in the market, there's questions. What do investors do? They sell. So
yeah,
we will see. We will see. All right, let's move on to like it, love it, leave it. We're sticking with that earnings focus, even though we haven't done any earnings previews this week. We're going to start with Gitlab. GTLB is their code, and they report today after the close.
I'd leave it. It fell below support of 45. Looks like it could drop to the bottom of the range.
Sentinel One, actually. Symbol is S. They report Tuesday after the close.
How'd they get the level S? Wasn't that Sprint?
That's what I thought.
That's what I thought too. I thought that was interesting because I thought S. I'm like, that's Sprint. Anyway, I'd leave it. Chart broke below support. It seems like everything broke support last week. Chart doesn't look super great either.
Lennar, LEN, they report Tuesday after the close as well.
I wouldn't expect good news. I would leave it. I think it hit the high recently and fell down. Home builders, not a good sector.
Adobe, ADBE, they report Wednesday after the close.
Another one that reversed off a key level. So I'd leave it. Fell below support. Maybe 317 is next.
Okay. Dollar General, DG, Thursday pre-market.
This is an interesting one. We'd leave it only because these guys they've done very well in this inflationary environment. I wonder if this market's finally saying they can't do it anymore. So I'd leave it.
Okay. And the last one, FedEx, a big name for us to look at, and they report Thursday after the close.
So I think they pre-announced a better number. I'm not sure about that. I would leave it because it fell below the 65-week last week, not by much, which means like Dick's. I think Dick's was one of our picks last week that was sitting on the 65-week, and the news was good, and the thing took off. We'd leave it only because it's below the 65-week, but it could be very susceptible to a reversal.
Well, Brendan, a lot's been taken in here today. And as I said, I think there's still a lot of questions sitting out here in this market. But thank you so much for running us through your experience with Bear and your thoughts and views on everything that's been happening now the last 4 days.
Yeah, lots of stuff. Lots more stuff next week to talk about.
All right. You have a great week, Brendan.
You too.
And for everyone else out there, good luck investing.